In 2022, a single announcement moved financial markets around the world. Not an election result. Not a corporate earnings report. A statement about interest rates from a single institution. That institution is the Federal Reserve. And understanding how it works and how it connects to the technology economy reveals one of the most fascinating and rarely discussed power structures in modern history. This episode is about that institution. Where it came from, how it works, and why it matters more to the future of artificial intelligence than most people realize. In the first 4 episodes of this series, we traced how power concentrates in infrastructure. We saw it happen in semiconductors, in cloud computing, in AI models, and in the deals that shape those industries. But every one of those industries runs on capital. And the institution that most directly shapes the cost and availability of capital in the United States, and by extension, much of the world, is the Federal Reserve. To understand the full power structure behind artificial intelligence, you need to understand this institution. The Federal Reserve is the central bank of the United States. It was created by Congress in 1930 to bring stability to the American financial system. At its core, the Fed has one primary function that affects almost every economic decision made in the country. It controls the base cost of borrowing money. It does this by setting something called the federal funds rate, the interest rate at which banks lend money to each other. That single number has an extraordinary ripple effect. When the Fed raises its rate, borrowing becomes more expensive across the entire economy. Car loans, business investments, and government financing all become costlier. When the Fed lowers its rate, borrowing becomes cheaper, economic activity tends to increase. No other institution in the United States has this specific capability. Understanding this one mechanism is the key to understanding everything else in this episode. The Federal Reserve has an unusual structure that surprises many people when they first learn about it. It was established by an act of Congress, and its leadership is appointed by the President and confirmed by the Senate. In that sense, it is a public institution, accountable to the democratic process. But the Federal Reserve System also includes 12 regional Federal Reserve Banks (SWAN) in each major region of the country. These regional banks are technically structured as private entities, with member commercial banks holding shares in them. This hybrid structure, part public, part private, was designed deliberately. The idea was to balance government oversight with operational independence from short-term political pressures. The Fed's profits are largely returned to the U.S. Treasury each year, and its decisions are documented, published, and eventually released to the public. But its core monetary policy decisions do not require approval from Congress or the President before taking effect. This independence, the degree to which it operates separately from the day-to-day political system, is one of the most discussed and debated features of modern central banking. To carry out its mission of economic stability, the Federal Reserve uses several tools. The most visible is the federal funds rate, which we've already covered. A second tool is the ability to buy and sell government securities, a process called open market operations, which adds or removes money from the financial system. A third, which became prominent after the 2008 financial crisis, is called quantitative easing. Through quantitative easing, the Fed purchases large quantities of financial assets, primarily government bonds, which injects money into the financial system and pushes down long-term interest rates. Between 2008 and 2022, the Federal Reserve's total assets grew from approximately $900 billion to nearly $9 trillion. That growth reflects the scale at which these tools were deployed during and after the 2008 financial crisis, and again during the economic disruption of 2020. The scale of these interventions was historically unprecedented, and the effects rippled through every sector of the economy, including technology. Here is a connection that is rarely discussed in technology coverage, but is well documented in economics. The extraordinary growth of the technology industry over the past 15 years did not happen in isolation. It happened during one of the longest periods of historically low interest rates in American history. From 2008 to 2022, the Federal Reserve kept its benchmark interest rate near zero. In an environment of near zero rates, traditional safe investments like savings accounts and government bonds generate minimal returns. This environment naturally directs investment capital toward higher growth opportunities, including technology companies and venture capital. The billions of dollars that flowed into AI startups, semiconductor companies, and cloud infrastructure during this period were partly a consequence of this broader investment environment. When the Fed began raising rates in 2022, the investment landscape shifted accordingly. Companies with strong underlying infrastructure and revenue like Nvidia and Microsoft continued to grow. Many early-stage technology companies that had relied on abundant low-cost capital found the environment significantly more challenging. The Federal Reserve did not target the technology industry specifically, but its policy decisions shaped the financial environment in which that industry grew. Given the scope of the Federal Reserve's influence, a natural question is, How is it overseen? The answer is that the Fed operates under a specific framework of accountability. Its chair and board members are appointed through the democratic process nominated by the president, confirmed by the Senate. It is required to report to Congress twice annually, and its chair testifies publicly before congressional committees. Its monetary policy decisions are published, and its meeting minutes are released to the public on a set schedule. In 2010, following the 2008 financial crisis, Congress passed legislation requiring a formal audit of the Federal Reserve's emergency lending programs. That audit, conducted by the Government Accountability Office, documented that the Fed had extended emergency loans totaling approximately $16 trillion to financial institutions during the crisis period. The audit finding was significant both for the scale of the interventions it documented, and because it demonstrated that formal oversight mechanisms could produce detailed, public information about the Fed's activities. The debate about whether existing oversight mechanisms are sufficient for an institution of the Fed's scale and influence is an ongoing one among economists, lawmakers, and policy to Federal Reserves. Independence from day-to-day political direction is not a design flaw. It is a deliberate feature and one that has substantial support among economists. The core argument is straightforward. Elected officials face short election cycles and strong incentives to boost economic conditions before votes, sometimes at the expense of long-term stability. A central bank insulated from those pressures can take a longer view raising rates when necessary to control inflation, even when doing so is economically uncomfortable in the short term. Research comparing countries with more and less independent central banks generally supports the conclusion that greater independence correlates with lower and more stable inflation. Most mainstream economists across a wide range of political perspectives support the concept of central bank independence. Even while debating the specific policies the Fed pursues, understanding this argument is important context for evaluating discussions about the Federal Reserve's role and structure. With that context in place, it becomes possible to see the full picture this series has been building. The AI power structure documented across the first 4 episodes of this series, the chip layer, the cloud layer, the model layer, was built during a specific financial era, an era shaped significantly by Federal Reserve monetary policy. Low interest rates made capital abundant and relatively inexpensive. Abundant capital made large, long-term technology infrastructure investments feasible. Those investments built the chip manufacturing capacity, the cloud networks, and the AI research organizations that now sit at the center of the AI economy. The Federal Reserve did not design this outcome, but the financial environment it created was one of the conditions that made it possible. This is how the Power Structure series connects its 2 major themes. Technology, infrastructure, and financial infrastructure are not separate stories. They are layers of the same system, each one shaping the conditions in which the other operates. The Federal Reserve is one of the most studied institutions in the world. Thousands of economists, researchers, and journalists analyze its decisions continuously. And yet for most people, outside of finance and economics, its structure, its tools, and its broader influence on the economy remain unfamiliar. The goal of this episode has been to change that, because understanding the Federal Reserve, how it was designed, what it does, and how its decisions connect to industries like technology and artificial intelligence is part of understanding the larger systems that shape the modern economy. The Power Structure series began with a question about who controls artificial intelligence. The answer, as this series has documented, is not simple. It involves chip companies and cloud providers and AI research organizations and the deals that connect them. And it involves the financial environment shaped in part by central banking policy, which all of those organizations grew. Understanding these connections doesn't require agreeing with any particular political position. It just requires looking at the full picture. The Power Structure series has now examined the hardware of AI, the software of AI, the deals that shaped it, and the financial environment that funded it. But there is one more force that shapes all of these systems: regulation. Governments around the world have been watching the concentration of power in technology and finance, and some of them have begun to respond. The European Union passed the most comprehensive AI regulation in history. Antitrust investigators in multiple countries have opened inquiries into big tech, and a genuinely open question has emerged. When power concentrates in infrastructure as quickly and as deeply as this series has documented, can regulation keep up? Or does the concentration reach a point where it becomes structurally difficult to reverse? That question and the governance, lawyers, and regulators trying to answer it is the subject of episode 6. Thanks for watching.